I think that in general, the dollar will weaken. I think it peaked out a year ago in October 2022. It went down sharply, then rebounded, and I think it's turning down again. I think the conditions in America are not as rosy as government statistics suggest. I think the economy is going into recession or is in recession already. For most people, the economic recession is a reality already because the wages have gone up less, then the cost of living increases. In view of that, I think that gold and other precious metals are still a good investment from a long-term perspective.
Gold prices have been on a remarkable upward trend for 5 consecutive trading sessions, surpassing the resistance level of $2,052 per ounce at the time of writing. This surge marks a significant peak for the yellow metal, the highest it has reached in 6 months. Spot gold prices, currently at $2,014.55 per troy ounce, have soared by 0.6%, hitting levels not seen since mid-May. Despite a temporary pullback to around $2,010, gold has showcased a remarkable increase of over 10% since its 7-month low at the start of October, hovering just 3% below its all-time high, recorded in August 2020. The ascent of gold is intricately tied to the dollar's declining value, which has seen a 3% drop against a basket of 6 major currencies in November. This decrease in the dollar's strength makes purchasing precious metals like gold more affordable for investors holding other currencies. Marc Faber, editor and publisher of the Gloom, Boom, and Doom report, believes the dollar peaked around October 2022 before experiencing a notable downturn. While acknowledging that gold isn't as inexpensive as it once was in 1970, when it was priced at $35 per ounce, Marc underscores its substantial growth in value over time. He emphasizes gold's historical performance as a dependable store of value, especially in the context of continuous money printing by central banks. The demand for gold has also been bolstered by central banks, as highlighted by the World Gold Council's data. These banks purchased a record 1,136 tons of gold last year and an additional 800 tons in the initial 3 quarters of 2023. Institutions like the People's Bank of China are leading this surge in gold acquisition, acquiring 181 tons, followed by Poland at 57 tons and Turkey at 39 tons. Indicating a robust and sustained interest in this precious metal. We will present clips from Marc Faber's interview with Kitco Mining. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
Well, I've been advising investors to own gold and other precious metals, silver, platinum, for the last 40 years. And I buy continuously every month some gold. And in my asset allocation, gold is a side of real estate, stocks, bonds and cash. Gold and precious metals, physical would be about 25%. So I have a large exposure to precious metals. I don't think that gold today is as cheap as it was in 1970, when it was at $35 an ounce. And so I can tell what the price level was, say, 50 years ago and what it is today. So let's say it's about up 10 times the price level. Gold, in the meantime, is up much more, from $35 an ounce to close to $2,000 an ounce. So gold has actually been a good store of value for what it is. And when I look at the commodities complex, say, oil would be cheaper than gold, or wheat, corn, soybeans, sugar, even coffee is much cheaper than gold. But I think in consideration of central banks whose function in the long run is to print money, we never forget that. A central bank exists to print money. In view of that, I think that gold and other precious metals are still a good investment from a long-term perspective and also from a safety aspect. There are times when paper is more expensive than the physical. Say in real estate stocks, they swing more than the value of the real estate. In precious metals, it's the same. Sometimes precious metals stocks are at a significant premium to the physical. And sometimes they're at a significant discount to the physical. At the present time, I think that mining stocks, gold, silver, platinum, are at a discount to the underlying physical precious metal. So now is the time to buy essentially precious metal stocks.
Marc's investment perspective leans towards diversified portfolios, especially in companies involved in gold and silver production through exploration or acquiring exploration firms. He notes a prevailing bias against gold among financial institutions and portfolio managers despite its general reputation as a relatively secure asset. Gold maintains price stability, exhibits durability during inflationary periods, and consistently sustains strong demand. If there's a shift in investment strategy towards gold, Marc anticipates that larger companies will be favored due to their liquidity, as smaller stocks lack the required liquidity for significant institutions like CalPERS, Vanguard, and BlackRock. Looking ahead to the end of 2023, Marc predicts a potential shift in focus for central banks. Major central banks worldwide are tightening monetary policy in response to rising inflation, initially caused by higher goods and energy prices and bottlenecks in global supply chains. Contrary to popular opinion, he doesn't foresee a significant tightening of monetary conditions despite some countries raising interest rates. Despite elevated interest rates in certain regions, this lack of monetary tightening leads Marc to anticipate a cooling of inflation in the coming 6 months, while still projecting a 30% increase in global price levels compared to 2018 and 2019. Let's get back to the interview.
You know, the big diversified companies, they do exploration or they buy exploration companies and they produce gold and silver. So I have both. But from a portfolio point of view, I believe that financial institutions and the mindset of portfolio managers at Fidelity and all these large financial institutions is against gold, because gold is honest money. And say if we measure stocks against gold over longer periods of time, sometimes stocks underperform gold. So the portfolio managers don't like to talk too much about gold. But if they will be forced to move into the gold sector, they'll buy the big ones because of the liquidity. Small stocks don't have enough liquidity for CalPERS and for Vanguard and for BlackRock and so forth. So they'll buy Barrick and Newmont and so forth. Well, in general, I think that central banks will move into... I want to express here a thought that is not widely shared. I don't think that central banks have tightened monetary conditions meaningfully. The absolute level of interest rates, you look at, say, Turkey and Argentina, they have inflation rates of over 100%, and interest rates at 100%. Is money tight? No. You can have an increase in interest rates in the US and money doesn't become tight. If money was tight, the spreads between junk bonds and treasuries would be much wider. It hasn't widened much. The VIX index volatility would shoot up, hasn't shot up. So I think that the monetary policies are still inflationary at the present time, and that for the next 6 months inflation will obviously cool down, but we will still be 30% higher in the price level in the world than we were in 2018, 2019. I think that people must recognize that they can't forecast the future. And they should be diversified. And by diversification, I mean not just diversified by having an account at Morgan, JP Morgan in New York, or Morgan Stanley or Goldman Sachs, and buy foreign stocks and buy gold mining shares, but to have physical diversification, that you have some assets in Canada and some assets in India and some assets in Singapore and some assets in Dubai and so forth. Because we have a world that is becoming polarized between the wealthy and developed Western countries under the hegemony of the United States and their allies like Canada and Australia, UK and Europe. And then you have BRICS, and BRICS countries that are becoming larger and have economically an increasingly large weight in the world and politically more influence. I mean, 100 years ago, the British could send troops to China and force the Chinese to pay them indemnity fees and transfer Hong Kong to them. Nowadays, you think the British could go to China and demand anything? Nothing.
Analysts predict gold might test its all-time high, nearing $2,075 per ounce by the end of 2023. As per recent daily chart trends, gold prices show a robust uptrend, breaking the psychological barrier at $2,000 per ounce. Bulls now target the all-time high of $2,070 per ounce, relying on potential US dollar weakness after the economic data release. What are your expectations regarding the future price trajectory of gold? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.